Does this signal the end of Europe as we know it? Now, I know that sounds hyperbole. I know that we have been looking for the end of the world as we know it for a long time, but we are watching the signs. We are watching the signposts. We are getting closer. We have massive problems with debt, massive problems with civil unrest. Now there's energy problems, and they only accumulate. What I'm talking about specifically is the European Union, though, and the ability to stay together. Now, for anybody who's been paying attention, over the last decade since they've been around, they've been threatening to break apart. However, they've stayed together regardless. So in this video, I'm going to break down what could finally be the point that splits the European Union apart. I think we've gotten to the point where they may not be able to recover from this. So we'll break it all down in this video. I'm going to show you the new policies they just put in place to try to hold it together that I think is only going to make the problem worse. It's something the whole world needs to be watching out for because it has massive implications even in the United States. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong. And almost everything that you see is wrong. I've been talking about this a lot. It's factually correct, but intellectually dishonest. And I want to show you kind of what's going on and what these policies are and what they could really mean. I got a new graphic up, trying to wake up the sleeping lions. My goal is for you to take this information and just share it. If we can get enough people to start seeing what's really going on, hopefully we can turn the tides. As my favorite, one of my favorite quotes from Sam Adams says, it doesn't take a majority to prevail, but just a small, irate minority, keen on setting brush fires in the minds of men. So let's take these ideas, let's spread them, let's share them, let's spread those brush fires. And if you want to help, you can click on that like button. It sends it out to more people for the algorithm. If you're not already subscribed, hit that subscribe button. All right, so trouble in Europe. European trouble. We are talking specifically about the continent of Europe, but more specifically the European Union that's there. And they have a big problem going on in Europe, similar to the United States. As a matter of fact, they have a big amount of inflation, a high amount of inflation, 8.6%, about what we see here in the United States. Euro annual inflation up to 8.6%. It's a problem for them, except for it's a much bigger problem for them because they have a lot different conditions than we have in the United States. So we're going to go through that. Specifically, what's going on is that the European Union is made up of a bunch of different countries. And some countries are doing much better, and some countries are doing much worse, as they have been since the start of the European Union. And that is the crux of the matter. We're going to take a look at that. So if we look at this chart right here, we can see the different types of inflation that we have. Of course, it's all bad, but we can see that all items are way up. And you can see that they haven't been able to get the inflation. Similar to the United States, here's 2012, so it's about the last decade. And you can see inflation was actually negative for most of this. This line right here is at zero. So we had inflation that was below zero. We had inflation that was below zero. They haven't been able to get inflation. Couldn't even get to 0%, much less the 2% they want. But then you can see right here how it has broken out, and now they don't know what to do. They can't get rid of it. And like I said, it's different countries, and it's really the southern European countries, the pigs. We're going to talk about that in a second. The pigs that are the problem. They're in really, really bad shape. And this is what I think is threatening the rest of Europe. We'll break it down. And we can see that the bonds are selling off in extreme ways. We can see European corporate bonds hit by the steepest sell-off in 20 years. That's not good. And so if the bonds are selling off, the debt, that means there's no more money. Remember, we live in a debt-based monetary system. All money is created through debt. If we don't increase the amount of debt, then we're falling. We're in a Ponzi. You can't taper a Ponzi. And so when you see that happening, especially at that aggressive rate, it's a problem. All right, now, is it all talk from the central bankers, or do they have a plan? Is there any type of action to fix this? Let's take a look at this. So the first thing that we know is, as I said, Europe has had this situation with negative or less than inflation, negative inflation. And so you can see that their central bank policy, their interest rates have reflected that. And you can see right here around 2011, 2012, the rates actually went negative. And so I think about half the bonds of the world are negative yielding. So that means when you typically loan someone money, you get your money back plus interest. In a negative yielding situation, you loan someone money and you get back less than what you loan them. Negative yielding, which is insane. Nobody in their right mind would do this. Only a completely messed up, broken financial system would even do that. But that's what's been happening in Europe. They've had negative interest rates. You can see below zero. for a number of years. And no matter how low or how negative, they still couldn't get the inflation. So a little bit different than the United States. The United States has still had a positive interest rate, which of course has continued to bring money to the United States. All right, but since they've had this going lower and lower and lower, as I've showed you for the last 12 years, finally, they're going to try to raise rates. Going to try, well, they're doing it, but I'm going to break that down for you. So, of course, in the United States, the Federal Reserve announced last November they were going to start raising rates. Of course, this year, the last several months, they have been raising rates. We've talked about that extensively. But when the United States and the dollar and the Federal Reserve starts raising rates, then the rest of the world kind of needs to start raising their rates as well. The problem is most of the world isn't capable of doing this, and this is where the crux of the matter lies. So the European Union says, okay, well, shoot, they didn't at first. They continued with their easing process. Finally, they said, okay, fine, we'll raise our rates. We're falling too far behind because of the soaring inflation that we started to get. And so for the first time in 11 years, we're going to start raising our rates. But that's where things fell off a cliff. So we can see the amount of bonds on their balance sheet. This is the debt. So this is going back till 2008. Now, for some of you that are old enough to remember, in 2008 was the global financial crash. And of course, they had to have a lot of stimulus there. You can see that. But it looks small when you compare to where we're at right here. Of course, here we have 2020, the pandemic, and they've had to add an enormous amount of debt just to stay afloat, which of course, this is the reason why there is so much inflation. So they were in this negative interest rates kind of for this period right here. And even though they were increasing their balance sheets, it wasn't really affecting them that much. But you can see this increase is a lot different. Now, what are they going to do about this? They have this massive balance sheet. So what's their plan? Well, Christine Lagarde, formerly of the IMF, now she's head of the ECB, and I always like to point out she's a convicted criminal, still running one of the world's largest central banks. She has a plan. Let's play this little video clip of it right here. Editor, go ahead and play that clip.
There is this graph about the balance sheet of the European Central Bank and the money that is on there now. And here it is. What I would like to show our viewers and ask the question about is, this is going over 8 trillion euros now. Mm-hmm. And isn't what you just told us about the cryptocurrencies, don't we see a gigantic bubble here on your balance sheet with the euro? And isn't this graph very nerve-wracking?
Well, I can tell you that there is 0 crypto assets in the balance sheet of the ECB.
That I know.
Point number one. Well, I just don't want any ambiguity about it.
Yeah.
But you have to think in terms of counterfactual. If we had not decided on March 18th, when we put together the pandemic emergency program and then subsequently increased the volume of commitment that we made to the European Union economies, we would be in a devastated situation. So I don't regret any of that move that we took on that day, which was 4 months into my job, to significantly increase the size of the balance sheet, because that's all we had. Yeah. Otherwise, the economy would have collapsed and it would have been even accelerated by a financial crisis.
You had to do it. It was the COVID crisis. You say that's
yes.
What we needed to do. But how do you get it?
It will
back?
come. It will come. In due course. Yeah.
How?
In due course, it will come.
Yeah.
No,
but do you sleep at night when you see this?
Of course, I have to sleep at night, and I have to worry every morning. Yeah.
Yeah. Okay.
All right, so did you hear her plan? You caught on to that, right? Her plan is no plan. So he asked, how are you going to get this off the balance sheet? And she says, yeah, it's just going to go down. It's just going to go down like magic. Like, who elects these people? Oh, that's right. Nobody does. They're unelected. That's right. And then if we look at this, like I said, here's where the real crux of the problem lies. Because the European Union is a bunch of independent countries, some countries are better, some countries are worse. And it's the southern states that are really making up the big problem. So this is the government debt to GDP ratio of the countries over in Europe. And what we have highlighted here are what we call the pigs. So that's Portugal, Italy, Greece, and Spain. So Greece, Italy, Portugal, Spain, right here. This is France, Belgium, Cyprus. And so what we can see is look at the amount of debt, almost 200% debt to GDP for Greece. Italy is over 150% and so forth. Now, that's a massive amount of debt for these individual countries, and they have a lot of debt because they don't have the economic powerhouse to get them out of it. But just so you know, under the European Union, each country is supposed to pull their own weight. And as a matter of fact, there's been limits set by the European Union that no country should get over 60% debt to GDP. 60. But here we are at almost 200% for Greece. Now, the countries that do really well probably don't like that. They don't like having to cover these countries who haven't been abiding by what their European Union contract says. Now, what is going to happen? Is this going to lead to another sovereign debt crisis? As I say again, that's exactly what I want to break down for you and show you what's happening. All right, so we have a bond problem, right? Bonds are debt, so when governments want money, they need to borrow money, they issue a bond. Easy enough. Corporations do the same thing. So we have a bond problem. The problem with the bonds is that the more debt you have, the less likely are you to pay it back, which means that if anyone else is going to loan you money, they're probably going to want a higher interest rate, a higher yield. All right, so that's what's happening. So the borrowing costs are going through the roof. There's a couple ways we can see this. First of all, the risk of default is going through the roof. So if I'm loaning you money and I'm afraid that you may not pay that back, I can buy insurance, a default swap, it's called, insurance in case you don't pay me back. And what we can see here, we have Greece, Italy, and Spain, three of the pig nations, going back for the last 2 years. And you can see they stayed relatively flat. This is the credit default swaps, which basically, when they go up, when people are buying more insurance, that means they have a higher likelihood of collapsing. And look what you can see right here. I mean, these things have completely skyrocketed. It's not so much for Spain, Greece, and Italy, of course, as I just showed you, the debt to GDP are the worst. And these are astronomical increases. Now, why is that a problem? Well, if they need to continue to borrow money, which they do because they don't produce enough money and they're on a debt-based system and nobody wants to loan to them, or their borrowing costs go up, then they can't borrow as much money. And you get the picture. The very fast-forwarded viewpoint of this is what's going on in Sri Lanka right now. Sri Lanka actually did default on their bonds, which means now nobody will loan them any money, which means they have no money, which means they aren't able to import any oil or food for their country, and the whole country is shut down. All right, we're seeing that in real time, and that's exactly where this is headed. We can see this again. This is the default swap spread. This is the B of A Euro High Yield Index adjusted spread. And again, you can see how high this is. Now, it was high right here. This was during the pandemic, of course. That was understandable. And we have to kind of go all the way back here to see how high it was before that. We'll skip that. These are just some charts so you can just see. Sometimes it's not just the move itself, but it's the direction of the move and it's how fast it's moved. So you can see on a decline right here, like it was over a period of time, or when this increased, it was over a long period of time. But this is like an almost astronomical straight up. So it's important to understand it from the charts, not just the number itself, it's the direction, but it's also the speed of the move itself. Now, there's also a metric called the fear gauge, where you can basically measure how bad things are based off of this fear gauge. And what we can see is that the European fear gauge is at its highest level since May of 2020, which again was the pandemic, when the entire world economy was shut down. So people are as fearful today as they were back then. And we can see it on a chart right here. Again, it's important to see it from the chart so you can see the direction of the move, but also the speed of the move. And here's the spread on the 10-year bond between the Italian and the German bond, which is pretty extreme. So Germany being the better bond, Italy being the worst bond, and that's the spread. You can see how fast that is increasing. Now, will history repeat? You know I love history. I talk about it all the time. History doesn't always repeat, but it rhymes quite often. Well, what has happened in European history, at least in recent history under the European Union? And we can see that Greece, remember, Greece is the worst country out of the bunch. Sorry about that, Greece. Greece and Italy, they're both fighting it out to see who could be the worst. And Greece has had to been bailed out multiple times already. They haven't been able to get their stuff together. They've been bailed out multiple times. We can see this, a $52 billion package here, a $141 billion package here, a $62 billion package here, over and over and over. And because of this, you can see, again, back to the interest rates or their borrowing costs, while they're not historically high, we can see this when they had their big problem, we can see that they are turning up a lot. So remember, it's not always the exact level, it's the direction of the move and the speed. If we zoom in a little bit so you can see this a little bit better, look how fast this has risen. Now again, it doesn't necessarily mean, it doesn't matter how high it goes, it's the increase. So borrowing costs have doubled. Imagine if your borrowing costs doubled, especially when you're on a debt-based system. Most of us aren't able to live on that. We don't live on our credit cards. But if you were and your costs doubled, that would be very bad. All right, so let's see, debt-based system, I need more debt to live, my borrowing costs are going up because no one wants to loan it to me, it's rising so fast that I can't afford it. Some countries like Italy and Greece are doing horribly, they've had to be bailed out multiple times. Some countries are doing better and hold that up. What's the game plan to get out of this? I showed you the video clip of Christine Lagarde, head of the ECB, and she just said, it'll come down. We don't know how. Magic, right? That's their plan. But what really is going to happen? What are the options to get out of this? Let's take a look at that. So as the European Union is basically trying to support their bonds by doing yield curve control. So that means in the free market, if nobody wants to loan you money, the rates that you're going to pay will go up and up and up until finally someone's willing to take that risk. Well, nations don't like that, so they try to control that yield curve by buying their own bonds. So if no one else wants to buy them, we'll keep buying them, basically is what's happening. Now, other nations have tried this and failed. All right, so here's an example of yield curve control and when it went bad. So here's a chart of the Royal Bank of Australia, and we can see back from 2020, they had been regularly buying bonds, almost 2 billion here, 4 billion here, 1 billion here, 5 billion here, and they kept buying. So they were buying to push this yield down, which they did, and then they kept buying, and they were buying, and they were buying to try to keep it down, which they were able to do. But finally, they weren't able to do it any longer. Eventually, all pegs break. George Soros became famously rich by breaking the Bank of England's peg and making $1 billion in a day. That was the Bank of England. This is the RBA, Royal Bank of Australia, and they were also trying to protect their peg, and it eventually broke. And remember, it's not just the size of the move, it's the speed as well. And look at what happened as soon as they weren't able to keep that peg down anymore. Now, if we zoom out a little bit more, we can see another chart of this. And this is a little bit of a different graph, and you can see this is where they had started the yield curve control, and they were able to bring it down. They were able to artificially keep it down, but eventually it broke right here, and look at where we are today. So pegs are meant to be broken. The Bank of England's peg was broken, Bank of Australia's peg was been broken, and the European pegs will eventually be broken. Now, there's a dangerous game that they're playing right here, right? All central banks are playing this. They're trying to balance quantitative easing with quantitative tightening. If we have too much easing, then we get way too much debt and we get way too much inflation. But if we try to tighten too much, we crash everything because we're on a debt-based system and you can't taper a Ponzi. And so they're stuck on this high wire act like this, trying to support the bond markets. Because again, if we don't give the government's debt and the corporation's debt, they go bust. We have to support the bond markets, but we're trying to fight inflation on the other hand. If inflation goes too high, then the people get upset and we have civil unrest. And so it's this dangerous tightrope walk that they're trying to do. And they're trying to hold the European Union together at the same time. Now they have a plan. In my opinion, it's only going to make it worse. I'm going to show you that. We can see here, the European Central Bank is to create a new tool to address what they call fragmentation risk. Fragmentation risk and temper a bond rout, a complete catastrophe, a complete sell-off in bonds. So what is this fragmentation risk that they have? Well, the fragmentation is the breakup of the European Union. Now, why would it break apart? Well, let's see. Imagine if you were back in college and you were the one that studied every day and you wanted to go to med school and you wanted to get a scholarship, and every single night, weekend, you were studying, trying to get your straight A's. And then there was people that were out partying all the time and they didn't study at all. and your teacher just said, well, you know what we're going to do, class, because these people, their grades are really bad and they're not able to get good grades. What we're going to do is we're going to take a couple points off of your grade, so we're going to knock you down to like a C+, and we're going to give it those points over here to these guys with the Fs, and we're going to bring them up to a C+ as well, and we're going to even you guys out. How does that sound? Would that be good? Well, I don't think anybody would like that. I certainly wouldn't. I can't imagine anybody would. But that's exactly what's happening. So what they're trying to say is, hey, the European Union, we're going to, we're going to take all the money that's being made in the northern countries like Germany, and we're going to stop, we're going to sell your bonds off, and then we're going to take that money and we're going to give it to Greece and Italy because they can't do good. They don't have austerity. They can't live on a budget. They constantly overspend. So we'll take your money and we'll give it to them. Does that sound good? Well, I don't think it sounds good. I don't think Germany's going to like that. I think they're going to get tired of that. As a matter of fact, when they had to bail out Greece the last couple of times, there was a great risk of this breaking apart. But today, the risk is even greater. Why? Well, one, the dollar amounts are even bigger. But two, we're in a completely different environment where today, each nation is almost in the survival for themselves. Because today, we have another crisis, which is an energy crisis. And so Germany needs energy, and they need it from other countries because they don't produce it themselves. They need it from Russia. They need the money. They can't be supporting dead weight. At what point do the northern states, the northern nations say, enough, we're done with this, we don't want to support it? Will the EU break? That is the question. This is Macro Alpha. I had him on my channel recently. He said, if Europe is run as an emerging market country, why are you surprised the euro is trading like an emerging market currency? So what does that mean, it's run as an emerging market country? Well, a country like Sri Lanka that has to continue to take on more debt to import its food and oil, and then it runs out of money, and then it has none. And if that's what Europe wants to continue to do, of course the currency is going to trade just like an emerging market. So what happens to the pigs? Portugal, Italy, Greece, Spain, the countries that can't carry their own weight. How long will Germany support it? My guess, not much longer. But I'd like to hear your guess. Leave me a comment and let me know, how much longer do you think the European Union can stay together, or is this fragmentation plan going to be too little too late? Let me know what you think in the comment down below. Of course, give me a thumbs up if you like this video. If you don't like it, that's okay. You can give me a thumbs down and hit that subscribe button while you're at it. And I want to give a shout out to Joe Consorti, who helped me with this video. I got a new research assistant. He'll put this together. So shout out to him. Check him out on Twitter at Joe Consorti. And that's what I got for you today. All right, to your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.